Amazing Friday morning to you. My name is Ayodele-Bamisaiye, coming to you live from our offices here in Dexteritas. It's another excellent Friday morning, and I'm happy to be here. This is Finance Friday, where I talk about, all things personal finance, enterprise, that can make a difference for the community. So, it's Friday morning. It's great to be here. And as usual, I am still talking about tax planning because guess what? There are so many angles to approach this from. But before we dive into the meat of the matter, I just wanted to, first things first, remind everybody out there that if you have the modest income persuasion, and for some reason, whatsoever reason it may be, your personal tax returns have not been filed for 2024 or 2023 or any year in particular, and you need support getting those filed, you can reach out to my friends at the FEI, and they will be happy to have those tax returns filed on your behalf. Now, how do you reach out to them? Send an email to operations@thefei.ca, and somebody will respond to you with a timing in which you can book an appointment, and those returns will be prepared and filed on your behalf. That's number one. Number two, Alberta Startup Court, a non-profit here in the city of Calgary, based out here in Calgary, supporting entrepreneurs across the province, where I happen to be, have the opportunity to support entrepreneurs, is rolling out a series of workshops, and those workshops are designed to support professionals and individuals looking to get into entrepreneurship or who are early in their entrepreneurship journey. So we'll be walking through all of the basics, mindset of an entrepreneur, what it means to start a business, run a business, corporate structures, funding and finance, financial management, marketing, sales, all of storytelling, all of those things. And the goal is to, create not exactly a cohort system, but an opportunity for you to bridge the gap, fill the gaps. If there's anything that you feel is deficient in your basic foundational knowledge, it's just an opportunity for you to do that. So keep an eye out on the LinkedIn page and other social handles of Startup Court, and you will be able to get the information when those workshops are holding. But they're going to start bright and early in the month of November, and they're going to run all the way into 2026. So that's pretty much what I have for you as far as Startup Court and the Financial Empowerment Initiative is concerned. For today's topic on tax planning, what am I talking about? You're interested, right? Excellent. That's why we're here. So I'm talking about compensation. You're a business owner. You are in business. You are making money, but the money may be yours. It may not be yours, because if you have a corporation, for example, the corporation owns the money. So how do you compensate yourself for all the work that you are doing? You started the business, you designed the business plan, you got the funding, you designed the products and the services, you hired the people, you are doing all this work that nobody seems to appreciate. But as the business owner, you have a right to compensation. So how do you pay yourself? That's the question I'm going to be answering this morning. So compensation typically comes in two forms. A third one is an option that's more or less like a transit point. First option for compensation is the same one that everybody else gets, a salary. You pay yourself a salary, i.e., every 2 weeks or every week or every month, you pay yourself a specific amount, which triggers statutory deductions, i.e. taxes, CPP, EI, on both the employer and the employee side, and all that is paid to the CRA. And then what is left, that net pay, is paid to you, right? That's what is called a salary. Yes, we all know what that is. And it's a business expense. So that reduces your company's tax if you're in a corporate situation. Don't worry, if you're a sole proprietorship, you can't pay yourself a salary from your sole proprietorship. The entire revenue of your business is considered personal income. So keep that in mind. So, like I was saying, a salary would trigger taxes. It will trigger CPP and EI due. CPP particularly, actually, because as a business owner, you are not obligated to pay EI, but you are definitely obligated to pay CPP, and you would pay as an employee as well as your corporation paying as an employer. Now, what that means is all those amounts are due to the CRA on the 15th of every month after you've been paid. So if you are paid on say May 15 and May 31, the statutory deductions are due to be remitted to the CRA by June the 15th at the latest. So that's how that will work. Now, what is there any benefit to paying yourself a salary? Of course, first things first, you get cash money. Everybody likes that. Number two, you build RRSP contribution room when you pay yourself a salary, and then you get CPP credits, either in terms of hours, pensionable hours, pensionable earnings, contributing to your CPP balances and what you can get at the point of retirement. Now, another good thing about a salary is that a salary is predictable. That means that you can use it for credit purposes. So you want to get a mortgage, a home equity line of credit, a credit card. That income is consistent and it will be considered to an extent if you pay yourself a salary. So that's that with the salary. A dividend, on the other hand, comes from after-tax profits of the corporation. Take note, I said after tax. So that means that if there are no profits after tax in the corporation, you cannot pay yourself a dividend, right? So that's something to note. And that instantly brings in a measure of risk, right? That creates a measure of risk that in terms of whether the dividend will ever come or not. Now, dividends do not support CPP contribution. You do not require CPP contributions. That also means that it does not contribute to your CPP eligibility in the future. Now, depending on the size of the corporation that you're dealing with and how much the corporation is making, if your corporation makes more income, way more income than $500,000 in net income, that means that not all the income is subject to the small business deduction. As a result of that, that dividend is taxed at a lower rate. However, if your corporation's profits are $500,000 or less and you claim the small business deduction, that means that your dividends are ineligible and therefore you will pay taxes on them at a higher rate. That's number one. Number two, the dividend gross up will apply to those dividends, which means that the amount will be taxed as if it is between 15 and 20% more than it actually is. So those are some of the downsides of paying yourself a dividend. However, it's great for flexibility. You can pay yourself a dividend during the year or at the end of the year, as the case may be, as long as there are profits against which to defray the dividends. Now, lastly, as a business owner, you can borrow money from your business, i.e. you draw out cash. Now, that cash draw has to be accounted for as income somewhere down the road, whether as a salary or a dividend. So you have to keep that in mind. You can't just take money and say, oh yeah, I took it, I spent it. It doesn't work that way. As long as you have taken the money and used it for personal purposes, you are indebted to the business, and that debt has to be accounted for, whether as a salary or a dividend, or it is paid back into the corporation sometime down the road. So a draw is not really income. It's just, a temporary situation that still needs to be resolved sometime later in the future. Now, I get this question all the time. Which one should I do? Should I pay myself a salary or should I pay myself a dividend? I have that question all the time. The fact is, there is no one better than the other. It's your circumstances that determine whether you should pay yourself a salary or pay a dividend. Most people will say, hey, a mix of a salary and a dividend really is where you should be. And what will that mix do for you? You are looking at how does this contribute to your tax situation, either taking a salary to get RRSP contribution room so that you can claw back some of those taxes, or taking a dividend so that you have cash flow from the profits of your business. Those are all some of the things that you are considering. So you are looking at retirement, so RRSPs, CPPs. You are looking at corporate profits. If there are profits, then a dividend is possible. If there are no profits, then you are limited to draws and the salary. You are looking at, does the corporation actually have the cash to pay you, right? And then you are looking at future financing. So do you need money to buy? Are you trying to buy a house or get into a mortgage? If you're trying to get into a mortgage, then definitely you need that salary because that is beneficial to you, right? So things like that are the thoughts that the things that you must consider to be able to determine whether you are going to do a salary or a dividend. Now, what are things that you need to avoid when you're making this, when you're in this situation and trying to make a decision around this? Number one, paying all salary with no regards to tax brackets. Paying yourself a $200,000 salary as a business owner making less than $500,000 in corporate profits may not be a smart idea. You may not be able to you may not be able to position yourself properly from a tax perspective. So you want to sit down and do the math, or work with somebody like me to do the math to make sure that you are putting yourself in the best possible position. Dividends only means that you have no RRSP contribution room created. That's not in your interest. Forgetting to declare and track how much you've drawn from your business in shareholder loans is not in your interest either. Because guess what? The CRA gets a copy of your books every year when you file your financial statements, and that can become a point of contention, which can result in back taxes for you personally. Now, last thing, which is very common error, waiting till spring, February, March, April, to determine whether you are going to take a salary or a dividend. That's not when you do that. You do that now. So this is the time that you look at your numbers and say, hey, I'm taking a salary or I'm taking a dividend. This is the time to do that. And that's why I'm bringing this to you now. So having said that, what way you can pay yourself, and one of the most powerful levers from a tax planning perspective is this choice or the mix of a salary or a dividend. Now, it's something that we can support you with. It's one of the questions I get frequently and I answer frequently, which is why I'm doing this. So if you are thinking about that and you are like, yeah, we have cash flow, I'm not exactly sure which way to go, we are profitable or we are not. If you have those questions, hit me up, send me a DM on LinkedIn or on Instagram or on Facebook. Let's have a conversation about your personal tax situation. And if you'd like to book a consultation, head to taxplanning@dexteritas.ca. I'm more than excited, to answer these questions, to support you to get the answers that you require to these questions. So this is week 4 of our 11-week process. Next week, we're going to be talking about how we make sure that you do not skimp on the write-offs or the deductions or the credits that are available to you depending on your tax situation. I am looking forward to having that conversation with you. It's an amazing Friday morning, and I'm excited at what we're going to get to do today. With that, that's all of my Friday morning. Have fun and have an excellent now.